Hey everyone, welcome back to LR Options. In this video, we will go over options trading for beginners. We will be explaining stock options using call options and put options, what an options contract is, determining whether a trade is a call or a put, what a long position is in stock options, how the expiration date determines the value of the option, and how time decay relates to stock options. We'll also go over some examples on the options chain and stock chart. If you would like to see more videos such as this one, please hit the subscribe button and the notification bell to receive notice of any new videos that I post. Okay, so let's begin. There are two kinds of options. There are put options and there are call options, simply called puts and calls. Let's look at an example here in the options chain. Okay, let's go to, let me see, what stock should we look at? Let's look at, okay, let's see if we can look at Apple. Can we look at Apple? All right, so let's open up this December 10th expiration. Okay, so the calls are over here on this side, and the puts are normally on this side. So these are the calls, and these are the puts. One option contract is made up of 100 shares of stock. You can buy or you can sell one contract or many. When you are buying call options, you pay the seller a strike price. So let's look, let's say we're going to be looking to buy a call in Apple stock. Okay, so the strike price would be that you would pay would be $1.49 per contract, which is made up of 100 shares. So that would be $149, because you would have to multiply 149 times 100. So that's $149. Now, when you buy a contract, you're basically saying you feel that the price of the stock is going up. When you buy an option, you have a long position in stock. If you sell the stock, you have a short position in the stock. So the way options work is by determining the price of the stock. Now, a call option's value goes up in price as the stock moves up. So let's look at this on a chart. Okay, let's see. Okay, looking at the wrong thing here. All right. So we're looking at Morgan Stanley, and let's see if we can make this a little bit larger. Okay, so let's say that a call, you're thinking, okay, you determine that the call option, you're going to trade a call option, and you feel that this stock is going to be going up. So as the stock moves up, its value goes up. So let's see over here. Let's look at Morgan Stanley on the date of December the 2nd. It opened at 95.39. During the day, the stock moved up and it closed at 98.69. So it went up in value. It went from 95.39 to a closing price of 98.67. Okay, so every week option has every stock option has an expiration date. The closer the expiration date, the less time there is before the option expires, and the less value an option will have. So let's go back to the options chain. So these are weeklies. Let's say you buy a call option in Apple stock for weekly on a Monday, it's going to be more valuable, going to have more value than if you wait till Thursday to purchase the same strike. So as time moves on, your call option is going to lose value. Monthly call options or monthly options will have more value than weekly app options and so on. So therefore, time acts as a wasting feature in options, and this is called time decay. So a 1 week option is going to be less valuable than a 1 month option. And the reason for this is because in a 1 month option, there is more time available for your stock to move in your favor. Okay, so let's summarize what we've gone through today. A call option is traded when you determine a stock will be moving up. A put option is when a stock will be moving down. Options are contracts made up of 100 shares each. If a stock moves up, then the call option goes up in value. If a stock moves down, and if it's a put trade, it goes up in value. The value of a stock option lessens as it gets closer to its expiration date. Thank you for visiting my channel. Please share, comment, subscribe, and I'll see you in the next video. Thank you. Bye-bye.